Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories now we're following in the BNN Bloomberg newsroom. Canada's merchandise trade deficit widened in January. Data from StatsCan showing the country's deficit expanded to $3.7 billion, driven by a drop in exports. Goods leaving the country were dragged lower by a sharp decline in shipments of motor vehicles and parts. Those exports fell to the lowest level since September of 21. Shipments to the U.S. were down nearly 4%. Imports were also lower. Shares of Descartes Systems are trading higher after the company posted stronger revenue and profit that topped expectations, up about a little more than 6% right now. Revenue rose 15% year over year. Analysts note the results signal a reversal for the stock, which has been dragged down by broader concerns about the software industry. Descartes says the first 2 months of the year have been volatile and uncertain for customers, but noted that shipping has been resilient. And shares of Ballard Power also seeing a surge. Look at that, 18%. And after the renewable energy equipment firm reported revenue and adjusted profit for the fourth quarter that surpassed expectations. Ballard also saw higher revenue in its fuel cell products and heavy-duty mobility units. The company's 2026 operating cost outlook also came in better than analysts were expecting. And taking a quick look at the markets, the TSX off by about a half point, being dragged down by financials, tech, and healthcare. They are all off by more than a full percentage point. Healthcare off by more than 2.4. South of the border, the U.S. markets, same situation. I think it's the S&P 500, the Dow, both off by 1.1, and the NASDAQ off by 1.3. Oil prices keep pushing higher, touching $100 U.S. a barrel as the crisis deepens in the Strait of Hormuz. Iran's new supreme leader is vowing to keep the key oil route closed. Markets are under pressure as a result, including the TSX. Here to discuss how investors can look into this long term and look for wins that way amid the ongoing geopolitical tensions is Wesley Blight, Vice President and Portfolio Manager at Scotia Global Asset Management. And Wesley, thanks very much for joining us.
Thanks for having me, Roger.
Okay. Where do we go with this? You're sitting here right now. It's so volatile, so undecided. How are you figuring out your next move with everything that's unfolding?
That's a good question. So at a high level, our job is total portfolio management. So we set a long-term strategic asset mix. Then we integrate active and passive management for the underlying fulfillment. And then we've got the ability to make tactical asset allocation decisions as well. And that's really focused on our outlook for what we anticipate happening over the next 12 to 18 months. So when we entered 2026, our base case was risk on, but balanced. So having that balanced approach, we were operating on the expectation that we were going to continue to have that AI-driven CapEx. Productivity was going to help broaden out earnings beyond the names that have been really driving growth for the last couple of years. We had global PMIs in expansionary territory, and then GDP forecasts were shifting from that recessionary fear towards that modest positive growth. At the same time, central banks had moved out of that deeply restrictive territory, and fiscal policy was still going to be a tailwind globally, with inflation being relatively low and expected to stay below targets. So that was kind of the thesis that we had for our tactical positioning, which is really trying to add incremental value at the portfolio level at the beginning of 26. We were aware that geopolitical tension was heightened, and when we obviously had the breakout of war in the Middle East, and first and foremost, that's a human tragedy, but from a market perspective, that energy shock that you described is really centered on the Strait of Hormuz. And that carries 20% of the world's oil consumption, as well as 20% of the world's LNG. The market reaction to that has been, not that it's straightforward, but I'd say heavily predicted, in that we saw Brent crude oil prices spike, we saw European natural gas spike, whereas North American gas has stayed relatively stable given its regional dynamics, with Canada and the US being net exporters. And I'd say importantly, energy prices are still below the extremes that we've seen in previous geopolitical contexts, but the direction and volatility, that still does matter. So what we've done is not really anchored specifically on the path or the timing of the conflict, but look to treat the move that we saw in prices as step change and look for areas where markets are overshooting their fundamentals. So that's where we've created additional opportunities to try and lean in and take advantage of the near-term dislocation that we've seen.
And where are you seeing people overshooting?
Yeah, so across the board, we've seen, I'd say on the rate side, we've seen a jump in yields, particularly in parts of the US and the European yield curve. That has created attractive entry points from our perspective to add some duration tactically on the view that if the shock worsens, it ultimately would become a growth headwind, and those elevated yields that we've seen over the last week or so can retrace. And then from an equities perspective, the heaviest de-risking has been in the international and emerging market side. And we talked about the importance of natural gas prices being elevated, having a disproportionate negative impact in Europe and emerging markets. We've added some modest exposure there where the markets have been a little bit dislocated. And then we've selectively reallocated some of our FX positions. We did have a long US dollar position. We've reduced that and leaning into a basket of non-North American currencies to try and add incremental value there as well. This is all in the context of a total portfolio. So we think of that as risk first. So we're adding 0.5% of risk to a portfolio overall. So you can think about that as being overweight equities by 3.5% relative to the strategic target. And then even though we have lowered the fixed income basket itself, we've added a little bit more duration as well. So you can think about that as being an additional 3 years of duration within the context of the tactical decision on its own.
And how does this compare what's unfolding in Iran, in the Gulf, with the AI? Are they comparable on the impact they could have on the markets, or are they two very separate things to you?
They're very separate things. From our perspective, AI is going to be a long-term productivity boost to the global economy. And there are 3 things that we have been looking for from an AI perspective that has helped keep us comfortable to be overweight equities overall. And that would be, number 1, the ability for these large cap tech names to continue to drive strong free cash flows. So we've seen that. Control their capital expenditure. Now, we have seen some bond issuance go up, but we haven't seen it be so significant that we believe it's going to be negative to their viability over the long term. So those 2 factors have been very helpful for us in terms of our confidence from an AI perspective. Now, we've seen pockets of dislocation created by AI over the last little while, but not enough to unwind the market overall. We view what's going on in Iran as being more concentrated. The knock-on impact of that has been very pointed in that it's an energy shock specifically, and we don't believe that that's going to translate into a deep-seated input for higher and sustained inflation going forward.
So then that brings in the Fed and the Bank of Canada. Do you see rate cuts? Do you see them holding? Do you see rate increases? Or is it, again, we have to kind of wait and see?
I think we have to wait and see on that one. Right now, rate cuts have been priced out of the market, but that can change relatively quickly, as we have seen the news coming out of the U.S. administration and the news coming out globally about the conflict really changing the market pricing dynamics very quickly.
Okay, Wesley, we have to wrap it up there, but thank you very much for joining us.
Thanks, Roger.
Wesley Blight is the Vice President and Portfolio Manager at Scotia Global Asset Management. Coming up, the war in Iran continues to fuel volatility in the global energy market. We'll get more on how that is impacting the aviation industry after this. The war in Iran is quickly becoming an economic crisis, with Iran targeting vessels in the critical Strait of Hormuz, and the U.S. president threatening Iran with harsher punishment if it continues to target global oil and shipping. CTV's Joy Melvin has more.
The Strait of Hormuz, a lifeline for global oil, now a war zone. Iran unleashing new attacks on shipping tankers, effectively cutting off 20% of the world's oil.
They have no radar. Their leaders are gone. And we could do a lot worse.
The U.S. president says they've hit Iran hard, blowing up Iranian vessels suspected of laying mines in the strait.
We took out just about all of their mine ships in one night.
But as energy prices skyrocket, sparking fears of an economic crisis, an urgent effort to keep prices down. Oil-rich nations agreeing to the largest release ever of its oil reserves.
Our countries will be making 400 million barrels of oil available. I repeat, 400 million barrels of oil.
Hoping to calm markets and nerves, Canada too working with its allies on energy exports.
Canada will do its part to contribute to the world's supply. That will bring prices down for Canadians. That will keep prices affordable for Canadians.
Meantime, the president, who calls this war a short-term excursion, also says he's not done with Iran yet. That's not going over well with key Trump supporters who feel betrayed.
He ran on no more wars and these stupid, senseless wars, and then we have one that we can't even really clearly define why we did it.
This, as reports suggest, the U.S. was to blame for that tragic strike at an Iranian elementary school, killing 170 people, mostly school-aged girls. An early military investigation says it was likely due to outdated intelligence. The president was asked about it.
I don't know about it.
With the new supreme leader, Iran insists it alone will decide the war's end, as the FBI now warns that sympathizers or proxies could try to launch attacks on U.S. soil.
And that was CTV's Joy Melvin. Let's get more now, some perspective on the implications from the war in Iran and the direct impact it is having on aviation. We're joined now in studio by Robert Kokonis, President and Managing Director of AirTrav Inc. And Robert, thank you very much did you fly up here from downtown?
Choppered up.
Choppered up.
Choppered up.
The life of an executive. It's so nice. The oil's bouncing around $95, $100 right now. The airlines, I mean, it's always a tough industry. What are they looking at with this right now and do they know what to do?
I think some have been holding back, but news today is that some carriers like Cathay Pacific, a few Europeans, starting to nudge up by their, even Transat here in Canada, nudging up by their base fares or fuel surcharges. But you said it right, tough gig, the airline business, to make money. And we're always susceptible to these geopolitical shocks. Go back to SARS, 9/11, the global financial crisis, the most recent pandemic. It's tough. And, let's say oil, the last 10 years, fuel prices for carriers have averaged about 24% of operating expenditures. But you get into that 30%, 33% zone, that's tough. And I'm going to expect if we see sustained oil prices in that $100 level, then I'm going to predict we're going to see some carriers on a global basis start to fall out of the system. Because you just can't withstand that kind of shock.
Without passing on, and even passing on the price, the increase, they still wouldn't be able to survive?
Well, we can pass it on, right? But it's economics 101, supply and demand. If I'm going to pass on, especially in aviation and airline travel, whether you're a consumer household, whether you're a business, it's somewhat of a discretionary spend. So we get that price elasticity of demand. And if you raise prices too much, you could potentially shake out the demand for travel, especially at a time we're in the middle of trade wars and other geopolitical strife. So I think the carriers are being very careful now as to how much we want to raise those prices, just sort of testing. If you're an airline flying a fairly uncompetitive route, maybe you're the only airline on that route, you've got a bit more leverage to do that. But if you're in a very hyper-competitive route, for example, across the North Atlantic, a little more difficult.
Right. And I want to talk more about the airlines possibly going under with that, but jet fuel prices have jumped more than 50%. It's crazy. That was even before.
Right.
That was even before.
So we call this the crack spread. So for example, between yesterday and the day before hostilities started, Oil prices, U.S. oil, so WTI has gone up by, I think, 33%. Jet fuel price, a basket of North American jet fuel has gone up by 48%. Crack spread corresponding gone up by 56%. It's especially tough for the airlines that hedge their exposure to jet fuel using WTI or Brent crude as their proxy instruments. Not a lot of futures markets for jet fuel, so most carriers will use either gas oil, heating oil, or they'll use crude oil. So that dissync between crude oil and jet fuel is a problem. So that is a challenge because jet fuel prices are absolutely skyrocketing right now.
And so that's pushing those airlines. Can you even take a guess at what percentage if this continues for any length of time and these prices stay up? Because we're also going, I mean, with this too, the whole of the Middle East has been completely rewired for flights pretty much because of what's unfolding. So we've got flight cancellations, we've got flights just not being brought back and new routes, added length on the routes. All these things are having an impact. Do you know how many airlines could be challenged right now?
I don't know. I think in Canada, I think we're in pretty good shape. I'm especially, I think Transat just reported their first quarter a couple of days ago. They've really shored up their financing, the balance sheet looking a lot better. All of our carriers, Porter, WestJet, Air Canada, plus Transat, I mean, we're in pretty decent shape. It's more on a global basis. Some of those marginal carriers that didn't have a very strong value proposition, their costs are too high, or they're embedded in markets where the pricing is too low, or a confluence of both those factors, those are the ones we're going to see. If I were to go back in time and correlate the price of oil with carrier bankruptcies, it is very, very clear that trend.
So we're talking about some of the discount airlines in Europe, things like that?
It could be. I mean, if I go back even like 8 years ago, some of the most profitable airlines in the world were the likes of Spirit and Allegiant in the U.S., these ultra low-cost carriers that had operating margins double or three times that of regular traditional carriers. But that model's changed as well, too. So anybody a little bit weaker is going to be actually holding their breath, hoping what's going on in the Middle East doesn't go more than another couple of weeks.
And this is tough because it's been a bit of a golden era for airlines right in the last couple of years. After the pandemic, it seems like they were coming back and on fairly solid footing.
I mean, it wasn't just, you and I stuffing cash under a mattress during the pandemic and start to travel, but it's been pretty good. And, it's a tough business, high fixed capital. Inputs like fuel make it tough as well, too. 2007, the most profitable decade in airline business that decade, 2.5% was the average aggregate global net profit after tax. So correct, it's been pretty good up to 2022, but this is the last thing our industry needed.
All right, and with that, obviously they're going to have to pass on prices, especially if these if the oil prices continue at the level we're at or go even higher. What might travelers be looking at? Business travelers heading to Europe, business travelers heading to Japan.
Right. Well, as an example, a proxy today, I think Cathay Pacific, which is a Hong Kong-based carrier, owned by the Swire Group, they announced from Canada, economy class surcharges increasing from about $100 to $200. So I like to put that in terms of family of four traveling for vacation. That's now an extra $400 each direction for that family, $800. So we might see some of that demand rub off a little bit as people evaluate the cost of travel. It's a tough gig. And then you have the Mexican problem. You got Canadians can't go to Cuba. Sort of elbows up, so pushing back on travel to the U.S. So it's a difficult position we're in right now, but I'm confident the industry is robust. We've done a great job in Canada, and let's see if our carriers can figure out a way to thread the needle through this turmoil.
And what's it going to take to get through this, do you think?
I think it's those with relatively healthy cash balances, strong balance sheets, resiliency, shifting also assets to where they can be deployed perhaps more profitably. You probably will see in this kind of situation routes that have been maybe more marginal producers for an airlines taking a decision to cut that route or pull back. In fact, we've seen it with Puerto Vallarta with all the cartel violence. WestJet, for example, has pulled back. They have a number of seasonal routes and they've canceled some of those routes a little bit earlier than normal. So I think it's tweaking things a little bit, pulling back in capacity. The worst case scenario, of course, is seeing furloughs, layoffs, and airlines having to park airplanes. Again, let's just wait and see how long this madness goes on for.
Okay. Robert, thank you very much for joining us.
You're welcome.
Robert Kokonis is president and managing director of AirTrav. Coming up, Canada's trade deficit widened in the month of January. We'll break it down after the break. Canada's trade deficit widened in the month of January as auto trade weakened. For more on the surprisingly soft numbers, we are joined now by BNN Bloomberg's Lindsay Biscay. Lindsay, thanks as always for dropping in, and wish we were coming in with better news, though.
I know, but you know what? Some analysts are saying this really isn't that much of a surprise, Roger, because when you look at the last couple of months
still not
had,
good, though.
it's
Even,
not
it may not be a
good.
surprise,
I'm trying to
but
put a
it's still
rosy
not
picture
good.
on this. I'm trying to start with a rosy picture before we get into these numbers. You're right. It's not great, though.
Yeah.
But yeah, when you look at the last couple of months leading up to this, the run-up, we've had such a run-up that there's not that much of a surprise.
Yeah.
We're seeing a bit of a pullback now. When we look at the numbers, though, trade deficit widens to $3.65 billion. So yeah, it's not good news. It's much wider than what many were expecting. And that's almost 3 times more than the deficit we saw in December, which was $1.3 billion. So we're seeing exports drop, imports drop as well. And a big part of that is, of course, the auto manufacturing plant. Vehicles, parts, of course, we saw exports drop. So when you're looking at the numbers, shipments fell to 21%, so a whopping 21%. Imports of vehicles and parts, meanwhile, also fell to 4.5%. A lot of that, of course, is the trade war and the tariffs that we've seen hit this sector so hard.
Yeah, and I mean, a lot of companies in that did a lot of the moving before the tariffs hit. So I think we're now seeing that it's
well, that's just it too, right? Like there was a lot of, yes, so that's a good point. I mean, Canada also, before there was threats of these tariffs, before they actually were initiated by Donald Trump, there was a lot of moving across the border. So you saw those numbers ramp up. And then with the tariffs in place, we saw those numbers really come down, and we're starting to see the effects of that. So when you see this decrease, you have to keep in mind the amount of imports and exports that were coming across the border, particularly though north to south before these tariffs came into place last April.
All right, automotive, that big drop. How do we look against America, and how do we look against other countries?
And that's the interesting part, right? Because obviously, as we talk about every day, everybody knows the U.S. is our largest trading partner. So when it comes to the U.S., Canada saw a trade surplus narrow to $5.4 billion. Exports dropped by 3.8%. Imports were down by 3.4%. So we know that the Prime Minister has been talking about really trying to rely less on the U.S., and we're seeing that is continuing to happen every month when we see these numbers come in. When it comes to other countries, though, this is always interesting as well. So imports from other countries, imports increased 2.1%. Majority of that is manufacturing equipment coming in from China. We've been bringing a lot of that in, apparently. Exports to other countries, though, dropped by 6.5%. And particularly when we look at December's numbers, we saw exports to other countries were actually up, mostly because of precious metals, wrought iron gold in particular, going to the UK. And we've seen less of that being shipped to the UK, and therefore that's part of the reason we've seen those prices drop. But higher energy exports actually help to offset some of that. So it's going to be interesting to see what happens moving forward in 2026. We don't know, because 2026 has been such a roller coaster. Yes. But there are thoughts that there's maybe some, I'm going to start rosy and rosy, that there's maybe some good things on the way when it comes to potentially our oil exports helping to boost us.
All right, the eternal optimist. Lindsay, thank you for that.
I'll try.
BNN Bloomberg's Lindsay Biscay. Coming up, Canadian space tech company MDA Space just debuted on the New York Stock Exchange. We sat down with the company's CEO, Mike Greenlee. That's just ahead. Aluminum prices have hit their highest level since 22 as the war in the Middle East continues. Prices are now above $3,500 a ton, driven by supply chain disruptions. Aluminum has surged since the start of the conflict in Iran, which has impacted supplies in the Persian Gulf. That accounts for 9% of global output. The White House is starting a new process to replace tariffs struck down by the Supreme Court. The Trump administration has opened a new trade investigation into manufacturing in other countries, which could eventually lead to new import taxes. Trump has said he will seek to replace the hundreds of billions of dollars in lost revenues after the Supreme Court ruled against his use of IEEPA tariffs. Shares of Algoma Steel are sharply lower after the company missed revenue estimates and reported a wider loss of $365 million in the fourth quarter. The Canadian steelmaker says tariffs weighed heavily on results, noting it paid more than $60 million in direct tariff costs during the quarter. Tariffs have been pressuring the company since they were first announced, with Algoma saying in December that it would eliminate roughly 1,000 jobs. And taking a look at the markets, another off day, although there's a bit of a recovery. That's being optimistic. TSX now off by 0.48% south of the border. Lots of red there as well. All of them well above 1% The S&P 500 off by 1.13, the Dow 1.18, and the Nasdaq off by 1.36. Canadian space tech company MDA Space debuted on the New York Stock Exchange today, officially entering the U.S. stock market with an IPO announced days earlier. To discuss the details of this new move, we were joined by Mike Greenlee, the CEO.
Lots of interest in the space sector in the United States market. There's a lot of space companies in the U.S. The space market is expanding rapidly globally, and we're a strong part of that. Within the space market, you have a wide range of companies. Some of them are startups. They're pre-profit. Whereas in our case, we're a 57-year-old company. We've delivered technology into over 450 missions during those 57 years. We have strong growth, strong persistent profitability, strong cash generation. So we're quite an attractive space stock in this community.
And why did you feel it was important that you moved down into the NYSE and not, like, say, the Nasdaq, and move down to the States in general?
Yeah, I think whether it was NASDAQ or NYSE, there's not a lot of difference there. We just picked NYSE for, just a series of small reasons. But it's in terms of why generally, it's really to get access to the U.S. investor. There are more space companies in the United States in the capital markets. As a result of that, there are more investors that are aware of the space economy, of space companies, the competitive dynamics, what the real growth opportunities are. As a result of that, folks are, giving higher valuations. They're willing to invest and really see the potential in space companies. And so it makes sense for us to be a part of that. We had a decent amount of U.S. investors as it was, but it's still a bit of a limit for people when you're only traded on the Toronto Stock Exchange for them to easily invest in you. And we want the full capability of the space investment community to be able to easily invest in us, which caused us to make this move.
All right, there's virtually no discount on the share price. Did you think about that before going public with it?
Oh, we certainly considered how much popularity we would have, and if a strong discount was going to be required. In the end, due to the strong popularity in the stock, the oversubscription that you mentioned multiple times, oversubscribed, we were able to really focus. We only put out a limited capital raise on this at $300 million. We were very intentional about this, very disciplined. We did not want to intentionally dilute our existing investor base very much at all, and so this is going to cause like a 8 to 9% dilution type of a thing, and as a result of that, that'll be regained quickly with the amount of enthusiasm that is seen around us, and it's provided a very successful entry into the U.S. markets.
Why was it important to cap it at that and not dilute the investors that are already there?
Just because we didn't really need the capital. Right now, we wanted to raise some capital. That allows us to be able to enter the market more efficiently. It encourages banks to pick up coverage of us, and we would like more coverage of our stock from the U.S. banks. We will succeed in that as a result of this maneuver. Having a small amount of capital can be helpful just to further strengthen the balance sheet. We have about $100 million right now on our revolver, our line of credit. We'll pay that back quick. Have a couple $100 million in the bank. So we're in a very, very strong position from a balance sheet perspective, which will give us a foundation to be able to, consider acquisitions as we move forward into the future. That's another benefit of the U.S. stock, is that we're able to transact when we consider acquisitions using cash, as we have done in the past, and or using stock in U.S. stock.
All right. Now, the first day is the fun day. It's the exciting day, ringing the bell and everything. Then you have to come back for day two. What's the focus? Who do you see as your competition? Is it SpaceX, or do you see yourself working with them? And how do you see? What do you see as your next step?
Yeah, for us, it'll be to continue to build our relationships with the U.S. investors. That's really happened well as a result of this U.S. IPO opportunity. The large majority of the investors that have been participated in this equity raise round have been U.S. investors. A number of those have been long-only investors. So nice, stable U.S. investors that really appreciate space stocks. And so that's been excellent for us. We'll continue to nurture those relationships, introduce ourselves to more investors, participate in the various conferences and forums that exist down throughout the United States, and engage this investor community moving forward. And that's what we'll do. Meanwhile, back at the ranch, we will continue to operate and expand the business globally. And we have a strong organic growth path ahead of us. We have a $40 billion pipeline of opportunity to pursue over the next 5 years. So we'll be busy engaging with that, looking for our next round of orders. While strategically, we consider acquisitions in the U.S. or Europe to be able to cause ourselves to further expand inorganically as we go through the next couple of years.
And so, but just going back, and SpaceX, do you see yourself working with them? Do you see them as competition? And are you
on SpaceX? We work with SpaceX for launch. For certainly, when we contract for launch, we often use SpaceX for that partnership. In terms of competing directly with SpaceX, I think some of our customers, you would say, compete with SpaceX. We have one of the world-leading digital communication satellites in our MDA Aurora product. We've just completed a new factory in Montreal, which will have the capacity this year to start producing 2 satellites per day, 400 satellites per year in high-volume production. We'll be selling those satellites to customers around the world that need to build broadband data networks to provide internet-like data services globally, and also for direct-to-device communication networks to talk directly from satellite to cell phone. Those networks will, in many cases, compete with SpaceX's networks. So we're enabling those network providers to have the latest technologies produced in high-volume manufacturing globally to be able to win that competition.
And I just want to sneak in one last question. 6 decades almost in Canada. Are you going to stay headquartered in Canada? And you talked about acquisitions. Is there any chance that you might be acquired?
We will stay headquartered in Canada. I think that the Canada Investment Act would have a lot to say about us ever being acquired. We are generally viewed as a strong, important asset in Canada with the new defense investment strategy, clearly identifying space as a sovereign capability area for defense in Canada, with Canada wanting to produce its space solutions in space in partnership with Canadian industry. All of those factors would work together to keep us as a Canadian headquartered company. But we will continue to expand globally and have delivery and, in some cases, manufacturing capability in other countries, so that we can build them some sovereign assets as well for their space interests.
And that was Mike Greenlee, CEO of MDA Space. Coming up, Google is collaborating with a high-fashion brand for its second shot at smart glasses. We'll have more on that and some of the implications of body-worn computers, essentially. We'll talk more about that after the break. Google's new partnership with Gentle Monster signals a shift in wearable tech, blending high fashion with next-gen AI technology. And also raises fresh questions on how wearing AI will reshape style, privacy, and the ways we interact with each other. Let's get some perspective now from Elizabeth Wissinger, professor of sociology from the City University of New York. And Professor, thank you very much for joining us.
I'm happy to be here.
This is their second kick at the can for smart glasses. Why is this drive for why do we need glasses that are smart?
Well, that's an excellent question. And as a lot of us know, it was not such a great idea the first time around. There were a lot of reasons why not, which I can treat first, and then speak to the reasons why there may be a chance that Google Glass won't turn into, can I say it on air?
You can say
Glass, you know what?
Yeah, we'll leave it at that.
We'll leave it at that. I think people know the reference. Although Gen Z might not, which I think Google is bargaining on. So the first time around, some of the problems with Google Glass, first of all, social norms were not ready for it. People were just getting used to the fact that there were phones and cameras. They could be filmed in places where they didn't necessarily want to have what they were doing recorded. There were phone-free zones. What a quaint idea, right? You would like certain places you couldn't go with your phone. I mean, there are private clubs like that now, but in New York City, there are places that are like social gathering places
I
where
love
the
it.
whole point is you can't bring your phone. Yeah, they're exclusive. But the point is that people weren't used to being on camera all the time. And the idea that the Google Glass could be turned on. You could take pictures with a blink. I don't know if you remember that,
Yep.
but you could blink your eye, take a picture. There was a lot of invasiveness to it. So that's part of what gave rise to that problematic nickname, which the social mores, the social norms were just really not ready for that kind of invasiveness. And at that time, a lot of wearable tech producers were leaning into the fact that the tech was cool. So obviously people would want to wear it, but they weren't thinking about a few issues. And one was, as I interviewed a wearable tech entrepreneur at the time, well, around 2014. And she said the market for people who want to look like androids is really small. So the idea of putting, as people may recall, Google Glass came with or without lenses, and it was a device you would wear kind of hanging over one eye. And you really looked a lot like a cyborg. And a little bit more backstory, if this is relevant, which I think it is.
Yeah.
So Google Glass, Steve Mann, among other people, were in the heat of developing wearable technologies in the 1990s, and they were at MIT. And there was a group of innovators who called themselves the Borg Group. And the Borg Group, have you heard of the Borg Group before?
No, I haven't. Now we also have to get the rest of the story in too. So we'll have to speed up a little bit.
Okay, sorry, I'm giving you way too much backstory.
That's all right.
The whole point is that these guys, they loved wearing computers on their faces. They used them as memory devices. They thought they were wonderful for like helping you remember your colleague's wife's name, things like that. And they thought that look was so cool. And a bunch of them ended up at Google. So that's the backstory of the computer on your face.
And so now they're going. Now they want to go sharp and sexy, and they hope that will appeal.
Yes. So Google invested lots of moolah into Google invested money into Gentle Monster, which is a super cool eyewear brand. I had not Gen Z, so I was less familiar with it. But now that I have come to get to know it, Google has made a really smart move by investing in Gentle Monster, which is a South Korean brand which tried to break into the eyewear market and really couldn't make it and decided to go their own way. So they have these incredible stores, 16 stores all over the world. Han Suk Kim was incredibly clever in the way that he created these retail experiences. Every single store has a story. Every single store, or almost all the stores, the one in Toronto at least, and the one in New York City has robotics. It's a very tech-forward brand, but it is super, super cool in the fashionable way. They've partnered with Maison Margiela. There is a lot of high fashion cred that the brand brings with it. And what I think is interesting is the idea of how tech on your face looks in different interpretations. So, and the way tech feels is so important. And I think the Gentle Monster brand might get it right. Their glasses are pretty sleek. And also they're going to offer a version without a camera. And if you think about social norms and some of the problems with the people who wore Google Glass before, there was a real uncomfortability surrounding eye contact. Oh, if you have glasses on, let's see if we can do a demonstration. You have glasses on and there's a screen in front of your eye and you're looking at the screen, I would call that smart glass side eye. And I don't think people are going to like it because eye contact is so important for communication.
But have we not changed? We're almost out of time. I just want to get this one more question. I mean, in the 10 years, 12 years since they first came out, they're on camera everywhere, and people don't bat an eye. Well, are we going to see a different reaction to it, and people won't care that much about it?
I think that Gen Z might enjoy the fact of buying smart glasses that don't have cameras and that they can listen to music and do all those things. And their turn to analog kind of points in that direction. I think that people who are like, whatever, the horse is out of the barn, I want to be able to take pictures whenever I want, are going to embrace glasses like this. And I do think as a sociologist, I'm not sure that the social norms have caught up yet, but they're getting closer. And if the AI thing is the killer app for these glasses, then people are going to embrace them.
All right, we have to wrap it up there, Professor, but thank you very much for joining us.
Oh, and Gen Z hates AI, by the way. Bye.
That was Elizabeth Wissinger, professor of sociology from the City University of New York. Still ahead, today's market movers with Bloomberg's Matthew Griffin. Time to check out some movers south of the border. And for that, we're joined by Bloomberg equities reporter Matthew Griffin. Matthew, thanks as always for joining us. Now, war is good for business if you're in the defense industry. It's also good for business, apparently, if you're in the fertilizer field, so to speak.
Yes. Well, Roger, thanks for having me on. And as you know, I've been closely following some of the stock market ripple effects from the war in Iran. And some of the stocks that have actually been among the biggest beneficiary, really even more so than energy stocks, for example, are fertilizer manufacturers. The big one on my screen today is CF Industries. They're up about 13%, now up about 35% since the conflict began. And what we've seen happen is a massive disruption to the supply of nitrogen fertilizers. That's urea is the big finished product, but CF is actually a major producer of ammonium, which is used to make urea. A lot of that is made in the Middle East. And then you add on top of that, if you can sort of go even further up the chain of how this is made, the surge in prices of natural gas, which is the product that you start with to make all of these fertilizer products, that supply has been disrupted, and that's compounding these disruptions. So then if you turn and you look at North American producers, you get supply disrupted in the rest of the world. That is pushing up supplies of their products. Not so good for farmers, not so good for consumers who may have to pay higher prices for food, but for the fertilizer producers and investors in them, so far this is being seen as a tailwind.
Yeah, and quite a few companies benefiting right now, aren't they?
Yes, you've also got Mosaic and Nutrien in fertilizers. You could also, again, look at energy, oil majors like Exxon and Chevron, chemical producers like Dow. Anywhere that supply is being disrupted out of the U.S., their peers out of the Middle East, their peers in the U.S., investors sending those stocks higher.
Okay, Bumble be flying right now. The dating website, everybody's happy with it. Apparently, you can find love on it.
Yes, Bumble, well, they are rolling out new tools to help people find love, particularly today. Bumble talking about a new AI dating matching tool that is going to help users apparently find matches they're more compatible with. You'll basically have a conversation with Bumble's AI system. It will learn about you. It will go and talk to the AIs of other users and basically figure out who's most compatible. It's not going to be writing your messages for you. What it's going to be doing is helping you find matches. But it's basically the latest tool that a major dating service is rolling out to try to appeal to Gen Z daters. You've also got the company giving a profit forecast for the year that's better than what analysts expected. And all of that adding up to a share boost today of as much as 50%, best day since 2021. Now, the stocks has been in a slump, still down about a quarter over the last 12 months, but this is helping turn things around.
And you don't have to answer this. You probably can't. So what if you use your AI to talk to their AI, and then their AI talks to the woman's AI or the other person's AI, and they're using AI? Is there anybody real? Do we get a real person after all that?
Well, I guess the idea
you are
is
going to try and answer that.
You have to go on the date and find out, would I guess be the idea. But I think that's a little bit tangential to what the company would want you to focus on here. Because again, this is not a system that's going to write your messages for you. The idea is it's going to help you find matches in the first place. There's still going to be a human in the loop, as we say.
All right. And have you ever used Bumble or any other dating apps? We got about 20 seconds. That's why I'm asking.
Yes, I have, Roger. I won't go into the details there, but as a 20-something, I've given him a spin.
All right.
How about you?
I used Facebook's dating app. I called it Facebook Marketplace, and it worked. I met my girlfriend on it. All right, we got to go.
I bought
Matthew.
a lamp on Facebook Marketplace.
We got to go. Matthew, have a good one. That wraps up this edition of Trading Day. I'm Roger Peterson. Have yourself a great day.